Okay, so how do you invest in real estate without actually buying a property? So over the last 15 years on over $250 million worth of real estate, we have done this and we've done it successfully every single time. How the heck do you do that and why is this structure so powerful? There's different nuances to it. I'm just gonna share with you how we do it and what's worked for us over the last 3,000 plus deals. For those of you that don't know me, my name is Jim Manning. I founded the Passive Wealth Show. This is my fourth business. The other three are multi-million-dollar companies that are still running to this day. And my goal with this and with this content is to help you convert yourself from working really hard for your money into an investor that has their money out there working for them really hard and building passive wealth for yourself. Okay, so how this has worked for over $250 million and how we have done it is it's called private lending. And when it comes to single family housing, okay, there's off-market deals. The best off-market deals are what we call motivated sellers. And the motivated seller needs to sell their house yesterday, okay? And when a motivated seller needs to sell their house yesterday, if you're a real estate investor and you get a house under contract, a big reason why those people sell is the speed of sale, okay? If you have 2 weeks that you need cash, a traditional mortgage, by the time they get the appraisal out there, by the time they go through all their paperwork and all their due diligence, it's really just too slow and the deal could be dead. So hard money lending companies is a resource that investors use quite a bit, especially when they don't have their own cash available for them. So hard money lending is a asset-based loan, and the structure that we do when we go out and we give an investor some money is we take a house, okay, and we do not lend more than 70% loan to value, LTV. Now, what makes this different than a traditional loan is they look at the person's credit. And when we're an asset-based loan, what we're able to do is look at a property that needs work, and if it's a $100,000 purchase and needs $50,000 in repairs and it's worth $300,000, we can lend on what that future value of $300,000 is times that 0.7. Okay, so when we have this structure up, an investor will find us, they'll say, hey, I need $150,000, the home's gonna be worth $300,000. We do the math and we look at the numbers, we analyze it and we say, okay. And I need the cash in 2 weeks, we say fine. So then what we do as the hard money lending company, it's really just a middleman, okay? What we do is we turn around and find private lenders who have the cash. And we take the private lenders' money and we use it to lend to the investors. And having this middleman is a really beneficial thing for our private lenders, by the way, because if you are a doctor or you're running your own business, you don't necessarily have time to set up a company that's going to verify that all the repairs are done, that if a borrower defaults, take back the property and do all the work to finish it and then resell it. So having this structure set up, the private lender wins at a really high level because it becomes a truly passive investment. And there's a layer of defense. Like in the case of a default, the way we have it structured is that we take on that risk and we take the property back. And if we break even on a deal or worst case scenario, we even lose money on a deal, which I don't know if has ever happened in our careers. I can't think of one example where we had to take back property that we didn't at least make a little bit of money on, by the way. And a big reason for that is when you really understand a marketplace and you understand the values of it, and you know how to repair properties. At one point we had 120 property flips going at a time a few years ago. When you understand these and have an expertise there, this structure is really hard for the hard money lending company to lose money on, okay? Knock on wood, but we've had a really good track record there. So then the private lenders, what they get, how we have it structured is a promissory note with our company. It says, hey, I'm giving this hard money lending company $100,000. You promise to repay me, okay? And then a servicing agreement for the specific property that we're lending money on as well. And we have that set up to be an additional barrier to make it additionally passive. The private lender is not going to have to worry about dealing with anything or doing anything on a foreclosure setup. So the biggest advantage that I think on this is it's an opportunity to get a fixed return that's not going up or down and it's not fluctuating. It's an actual diversification from the stock market and it's a great passive income opportunity while being able to be lazy and just kind of sitting on the couch and not really doing anything. And when you have the right entity or the right structure in place and is able to, should something go sideways, has the financial means to take care of it, the risk profile is really very low on these structures. So to recap, yes, you can invest in real estate without actually buying property. You can have somebody else do all the work. This is one of my all-time favorite structures. I personally invest this way, and the risk, because it's a 70% loan to value, and when you stack on a company that has a financial means to take care of any sort of default, when you have that all stacked together, the risk profile is very, very low in my opinion. So I hope you got value out of this content. Make sure you check out some of our other content. Hope you have a wonderful day. Appreciate your time.